The first thing that will go through your mind when you see this video is that, oh God, not another moving average video. And let me tell you, the last thing which will go through your mind after you have finished seeing this video is, thank God I saw this video. So today we are going to introduce you to a fantastic moving average, which is probably one of the best moving averages. Let us begin with understanding what is a moving average. A moving average is a body of data which is averaged and which moves forward with time. It is generally calculated on time series data, such as closing prices of a stock. Moving averages are confirmatory and not predictive tools. Since old data is used in the calculation of a moving averages are lagging tools. They lag behind the current data. Why? Because old data has come into the calculation of the moving average. Normally, they are used for trend confirmation. Now, if prices are pulling away from a moving average, the asset is trending. If they are clustered around a moving average, the asset is in a trading range. The lag of a moving average is the bane of the moving average. It is the negative point of a moving average. And major attempts have been made by people all around the world to reduce the lag so that moving averages can follow the movement of the prices as accurately as possible. Now, what is a trend? A trend evolves when masses of traders in a crowd become convinced about a singular direction of the market. So we have an uptrend if masses of traders become bullish, a downtrend if masses of traders become bearish, and a trading range or a sideways market if they are confused. So a moving average is a trending market tool. It cannot be used in a trading range because the sideways market will give you too many erroneous signals if you use a moving average. What is the most important signal from a moving average? It is the slope of the moving average. If it is upward sloping, then it is an uptrend. If it is downward sloping, it is a downtrend. And the relative positioning of the price with respect to the moving average tells you whether the market is stronger than before or weaker than before. A crossover of prices from below a moving average to above a moving average signals a buy, and a crossover of prices from above a moving average to below a moving average signals a sell. Also, short term moving averages to long term moving average crossovers also give you similar signals. The most robust automated trading systems based on technical analysis are based on moving averages. You have other kind of algorithmic systems like order flow and statistical and so on, but technical analysis based algorithmic systems use moving average as the most robust base. So the moving average has to have a time period associated with it. Normally the time period is ranging from 5 periods to 200 periods. However, the moving average for short to medium term swing trading is ideally the 13 period moving average. An extremely important experience based advice which I'm giving you is, do not use moving averages on time frames which are less than hourly. You can use it on 5 minutes, 15 minutes, 30 minutes. Nobody is going to stop you. However, my genuine advice to you would be to use moving averages on a minimum of an hourly time frame upwards. The reason being that the moment you go to lower time frames, movements of the market become more random, and therefore whipsaws, which are erroneous signals from moving averages, will increase in number. Therefore, it is better to use moving averages on a minimum of an hourly upwards, hourly, daily, weekly, and so on. The moving average, which I want to familiarize you with today, has greatly reduced the lag from the conventional moving averages of simple and exponential. These are the two moving averages which 99% of traders use all over the world. The moving average, which I discussed today, is based on a proprietary moving average called the Zurich moving average, which is, as I told you, proprietary and therefore not available for use unless you purchase it. However, this methodology, which I'm going to familiarize you with today, simulates using a certain amount of guesswork a version of the Zurich moving average. So let us call this moving average X, which is based on the ATR, which is the average true range over a period of time, which is a proxy for volatility and is therefore adaptive in nature. In faster moving markets, it will automatically adapt itself. In slower moving markets, it will automatically adapt itself. And the second thing which it uses is the DIMA, or the double exponential moving average, which was formulated by Patrick Mulloy in 1994, which incorporates very fast reactivity, low lag, and high smoothness due to its methodology of calculation. Since X is using lag reducing mathematics and is really fast with low lag, it opens itself up to rapidly changing and misbehaving in a trading range market. So that's like sitting in a very fast car and feeling uncomfortable with the speed. So, what do we do to make the lag comfortable? We introduce another mathematical tool, which is a simulated Kalman filter. It was formulated by a person called Rudolf Kalman in 1960. We will call the Kalman filter, which is a simulated version of the original. Why? This is a powerful mathematical algorithm which is used to estimate the state of a dynamic system from a series of incomplete and noisy measurements. The Kalman filter, therefore, continuously predicts and corrects estimates over time, making it ideal for real time tracking and forecasting. Now, once we calculate X, which is extremely fast, and Y, which is noise reducing, we average the two to find the median of speed and reliability, which is X plus Y divided by 2. This is what I call fast adaptive signal tracking. Remember, moving averages attempt to attenuate the noise and amplify the signal. So, if I now show you the comparison of a 13 period fast with a 13 period exponential moving average and a 13 period simple moving average, you will see its power automatically. The proof of the pudding is in the eating. You may plot this on any chart of your choice and compare it with the EMA and the SMA. If you are convinced of its usage, then please consult a professional and registered portfolio manager to assist you with your trades. The source code of this fast moving average is given in the description of this video, which you can copy and paste in TradingView and use it. If you find it useful, go ahead and start using it. Here are two examples, one on an hourly chart, one on a daily chart of fast as compared to EMA and SMA. On the hourly chart, I show you the Nifty. This red line is fast. The blue line is the exponential moving average, and the green line is the simple moving average. You can see how quickly the fast responds to changes in the direction of the price. A second example is on the daily chart of the Nifty, which will show you a similar result, showing you that fast is superior to the exponential moving average and the simple moving average. You are free to adjust the parameters in fast, since you have the source code, to suit your trading style. Remember, this is an educational video, and we hope that you have learned something new in this video and are now saying, thank God I saw this video. Please like, subscribe, and share this video with as many friends and groups as you can. Our purpose is to spread honest and genuine technical knowledge to as many people as we can. All the best in your trading till our next video.